Oh, hi. Welcome back to the final lecture of ratio analysis. In this lecture, we're going to do the actual um, exercise, Excel exercise of the ratio variables. And since we discussed um, in detail and in depth the entire aspect of all five categories of ratio variables. Now we're gonna actually look into the balance sheet and income statements and find the ratios for that particular balance sheet and income statement. So I hope you're all able to see uh, uh, this example, right? And so we have a balance sheet and income statement. And let me uh, zoom in a little. But of course, you may not be able to see the entire uh, financial statements because we are zoomed in. But, we'll just bear with me. We'll have to scroll up and down to actually look up the data. And this is also the file that you can find in the lecture notes folder. I mean, currently it's in the temporary folder, but all the lecture notes are found in the Blackboard. So, before we went online, we used this file in class. Also, in the past couple of video segments, we also did exercise with this file. So the bottom tab for our exercise is exercise, right? The name of the bottom tab is exercise. So now, let's see what it is. First of all, ROA. We know what it is, right? It's not going to be that difficult. All you need to do is, okay, ROA is, simply what? Profit over total assets. Where's the profit? Where do you look? Where do you have to look? You have to uh, look up the income statement, and at the bottom of the income statement, net profit. That's the profit, right? Net income, net profit, or EAT, right? And then you divide that by what? Total assets. There you are. There's the total assets. There you go. So the ROA is 5.26. Now let's do let's go to ROE, return on equity. So then it's the same numerator, net profit, and then divided by, and where's the equity? Well, you have to look up the balance sheet for equity. There's the equity. So there you go. That's the return on equity. Now here's one thing that is that we need to discuss. I mean, there's a variant. Actually, there's a variant variant of ROA. Now let's think about it. The return on assets, the formula for return on assets is, actually you understand it as net profit over total assets. But sometimes they use also EBIT, right? EBIT over total assets. And where's the EBIT? This is the EBIT, right? Operating income. That's the EBIT over total assets. And there you go. Of course, you should give that percentage and give it at least 2 decimal places. Okay, now that makes the ROA much better. But why? Why do they? I mean, how come there are 2 measures of ROA? Now, remember that when we discussed ROA and ROE, remember that the profit belongs only to the equity holders, right? So in other words, there are 2 types of investors or stakeholders in terms of financing. We all know there are equity holders and debt holders, right? Debt holders are also called creditors or lenders, also called bondholders, right? Now, think about it. The total assets, all the capital, right, came from basically debt and equity, right? And I told you, since the net profit belongs only to the shareholders or equity holders or stockholders, right? Actually, net profit is totally useless indicator, or I mean, it's not totally a useless indicator. I mean, to lend money, right? You have to know that the company has positive profit, and not just positive profit, a good profit compared to the industry average, right? But anyway, even though that is a large, a very broad indicator of the company's profitability, right? But then still that net profit doesn't have has nothing to do with the debt holders. The debt holders or the bondholders, creditors, lenders don't get anything, don't get any, even a sliver of that profit, right? So actually, for the bondholders or debt holders, more instead of using net profit as the numerator, which doesn't even belong to them, they would rather use EBIT over, right? EBIT over total assets. Why? Because think about it. EBIT is the a broader or a broader level of profit than net profit, because it's before paying interest and taxes. And what is important to the bondholders is the company's ability to pay interest, right? And since the interest comes from the EBIT or operating income, right? So from the bondholders' perspective or debt holders' perspective, more relevant measure of return on assets is EBIT over total assets. Okay, so but in general, right, routine, when they say return on assets, refer routinely to this, right? This is unless this is the ratio that is used under specific condition that the bondholders preferred measure of ROA, right? Now, price earnings ratio and market value to book value ratio, but I used P for market value, so let's change that to P. But we're going to come back to this later because these are the market valuation ratios. So we went over the range of variables in this order, from starting from profitability category and liquidity category, right? Asset management category, and then finally, finally we did this, right? So let's go to the current ratios, which is current assets over current liabilities, right? So total current assets, that's the number, and current liabilities, there it is. So hit enter. 1.94. And what did I say is the threshold? The threshold number is 2. This is slightly below that 2, right? But it isn't that critical, because it's close to 2. It's not like, this company is going to go bankrupt, right? Anytime soon. They have sufficient working capital to cover for their current liabilities. Now, quick ratio is what? It's basically current ratio minus inventory, right? Just not the inventory, right? So our current assets is there, and then the inventory is this. So you subtract that and divide it by current liabilities. There you go. And hit enter. Okay, 1.28. So did they meet the threshold? They met the threshold. The threshold for quick ratio is 1, so they barely made it. Okay. Now, inventory turnover ratio, right? So inventory turnover ratio is what for a retail business? Even for retail business, the preferred method is manufacturer's method. In other words, CGS over beginning inventory, the average inventory, which is beginning inventory plus ending inventory, divided by 2. So we will use the preferred method, which is where's the CGS? Here's the CGS over beginning inventory plus ending inventory, right? Divided by 2. But then we should be careful. This whole thing is the denominator, right? If you don't do it like this, then this will be multiplied to the numerator, right? So keep it that way, and then there you go. So their inventory turnover ratio is 2.68, but once again, there's no given absolute, threshold. You'll have to compare it with the industry average, and if it is better than the industry average, you're good. If it is less than the industry average, you're basically you're less likely to generate the revenue that is even normal level for that industry. Now, fixed assets turnover ratio is what? Revenue over fixed assets, total fixed assets. So where do you go? Your total fixed assets is this, right? So total non-current assets. There you go. Okay, that seems, once again, we don't know. I mean, whether this number is good or bad. You'll have to compare it with the industry average, right? But for any manufacturer, right? Unless it is like, unless you're like a paperclip manufacturer, right? Paperclip maker, you would have huge, you would have huge amount invested in the plant and equipment. So it won't be recovered, right? Over a short production horizon, right? It would take, at least just to recover the fixed assets, you would have to, because revenue, this operating period is 0.38. If you operate for 3 periods, right? It could be years, or it could be 3 years, or most likely, it could be quarters, it could be, but years most likely. If you're a manufacturer with decent capital investment, right, in the fixed assets, right, it would take years to recover your initial investment or sunk cost in the fixed assets. Now, the debt ratio is what? It's the total debt over total assets. And total debt, you can, easily found total liabilities, right? Divided by total assets. So total assets. And then that's what? 0.56. So that clearly, is indicative of what kind of capital structure this company is in. They have 56% debt. That means 34%. I mean 44% equity, right? 44% equity. Their leverage is relatively high, but any leverage greater than 50% would be already considered relatively high, because there's more debt. This company is financed by more debt than equity. But also, depending on the industry, this may be still a very low number. Why? If you're an airlines industry, then airlines would have a huge debt proportion, right? Why? Airlines are generally, heavily leveraged. Why? Think about it. How on a commercial airliner, right? A commercial airlines company. They would have to have at least a fleet of commercial passenger jet plane, which would be something like Airbus 320 or Boeing 747. A fleet would consist of at least something like a dozen aircrafts like that, and obviously they are very expensive, right? They are like tens of millions of dollars, right? At least tens of millions of dollars or hundreds of millions of dollars. But then think about it. How would you raise money to buy those aircrafts? Well, you might think, oh, well, you sell stocks. But first of all, if you are a startup airline, is it easy to sell stocks? Any startup, first of all, a startup cannot be listed in the stock market, right? Because it's a startup. There's it's a big question mark, right? That company's fate is a big question mark. And you don't have any track record. You are a startup, right? So it's not easy to sell stocks, right? And even if you sell stocks, that's just you would be it would be through a private deal, right? And you would probably, if a venture capital is willing to invest in you, then they would. But this is not high tech industry. It's not like high tech with huge growth potential. Think about airlines. Do you realize how competitive airlines industry is? Airlines are learning. Airlines are running on very thin profit margin because airlines are very competitive. They are, especially in since 1990s, air travel has become more uh, popular. I mean, uh, and flights have become much more affordable compared to prior to 1980s or even prior to 1990s, right? That means there are so many airlines competing for passengers, right? So their profit margin is very slim, right? So I mean that's the reality, and if you have some understanding of the industry uh, reality of the industry, you cannot just simply say, "Oh, sell stocks." Of course, hypothetically, you can sell stocks, but it's all hypothetical situation. But the reality is, it's very hard to sell stocks for a startup, right? But then, how would you acquire these expensive aircrafts? Well, then you'll have to, if you cannot sell stocks, then you'll have to borrow. But then think about it. Is borrowing going to be easy for a startup? No, borrowing is not easy at all for the startup, right? And especially in a very competitive industry, right? Where the profit margin is very slim. And the banking industry is a very conservative industry. They are not going to easily lend money. It's gonna most of the loan applications get declined, right? And if it is a very risky business, and why is it risky? Because it's very competitive. Highly competitive industry means your chances of getting crowded out, right, is very high, right? So anyway, so if borrowing is not easy, then how can they buy aircrafts? Well, but for airlines industry, borrowing is still lending is still possible. Lending is done. Why? Because of the collateral value, right? Why? What collaterals? Think about it. If you buy aircrafts on borrowing, on the loan, they're not going to lend it for free. They're not going to lend it for nothing. They are lending it only because you are using that money to buy aircrafts. So these aircrafts are automatically becoming a collateral, right? It's just like a car financing. If you buy a car with financing, right? What does that mean? You make a small down payment, right? If you're buying a $30,000 car, you're making a small down payment of something like, let's say $5,000, $4,000, $3,000, $2,000, $6,000. If you are making a down payment of 5,000, the balance 25K is actually paid for by the bank. It's paid to whom? The dealership. You pay $5,000 to the dealership, and we talked about this in the time value of money, right? So you understand the this process of financing, right? When these airlines buy aircrafts, and banks are happy to lend. Why? They can collateralize, right? They can take these aircrafts as collaterals, meaning so the most equipments like businesses, when they borrow money from the bank, then they will and if they are using that, if they are using the loan, they are buying, equipment, right? This equipment becomes automatically collateral, right? The equipment is put up as collateral automatically, just like buying a house or buying a car. When you get a mortgage and buy a house, then your house is already put up as collateral. So these aircrafts are put up as collateral automatically. So if you default, then they will foreclose on these aircrafts, and they sell it off and they recover, right? Their principal, right? Or rather the principal balance, right? Because you've been paying, amortizing up to that point. Now, so as I said, anyway, that's why airlines industry is heavily leveraged. They are, that's the characteristics of that industry. So would be the railroad, industry, right? I mean, railroad cars, trains, they get collateralized. So whether this leverage ratio is high or low, you have to look at the industry average. Okay. Now, what about the times interest earned? Now, times interest earned is, basically EBIT over interest payment. So where's the EBIT? Operating income is the EBIT, right? And then you divide it by interest payment. There's interest payment, right? You can find interest here, or you can find interest here as well. So there you go. Well, the numbers kind of, okay, you don't need so many floating digits, and it's your responsibility to keep it, make it neat. Okay, so something like 3 decimal places, right? That would be good to keep it neat. Why is it? Oh, I think it's because of the something at the bottom. $14 would be okay for the width, column width. Now next, so we are done with all the other categories, but the market valuation category. So first of all, price earnings ratio, price earnings. So price earnings ratio is the market price. This is the market price, right? And earnings per share. So what's the earnings per share? First of all, we will need to know earnings per share. And this company's EAT, right? Earnings per share is EAT divided by number of shares. This is the EAT divided by number of shares. Okay, and the earnings per share is this, right? And then price earnings ratio, that's the market price, over earnings per share. Oh, okay. That looks like high, relatively high price earnings ratio, but once again, you have to compare it with the industry average. But overall, like for across the overall U.S. economy, which is represented by S&P 500. If it is S&P 500 in general, on average, it has about price earnings ratio of about 20, right? So you can say this is relatively high, but also you have to compare it with the industry average. For this industry, it may not be high number. Now, and market price to book value ratio. And so next question is then, we know what market price is, it's given. what's the book value per share? Now, book value per share at time 0, right? But let's say this is book value per share because we have income statement. Let's say book value per share is at time 1. Okay, you understand? So we need actually 2 balance sheets and 1 statement, but since we have just one balance sheet, we will assume that this is the equity at time 0, right? So at the beginning of the year, that's the equity. But at the end of the year, the equity will, even though they didn't sell any new stocks, there's as long as the company is making positive profit, right? There will be additional equity because this profit is equity in terms of capital component, right? In terms of nature of capital component, net profit is equity. Why? Because this belongs to the owners, and this is certainly not debt in terms of nature of capital. It belongs to the owners, so it's equity, right? It doesn't belong to anybody else. It belongs to the owners. It's owned by owners, right? Free of debt, and this is what the company owes to the owners, but they don't. Company doesn't distribute it to the owners, right? So think about it. Equity is the paid-in capital, right? Paid-in capital. That means, at time 0, right? Shareholders, the equity holders, paid in $3.8 million, right? They bought stocks for $3.8 million, right? Worth of stocks. I mean, through 160,000 shares. So that's paid in capital. The equity was paid in. But this is not paid in, it is generated by the company's operating activity, right? So it is additional equity that belongs to the owners and generated by company's operating activity, right? So at time 1, right, the equity will have increased by as much as this, right? So equity at time 1 will be equity at time 0 plus EAT at time 1. So therefore, we can calculate book value per share at time 1, which is, basically equity at time 0 plus additional equity, EAT at time 1. Now that's equity at time 1 divided by number of shares. Okay, there you go. That's book value per share at time 1. Then if you calculate market price to book value ratio, there you go. Oops, something. Okay, I was this right. Something. Okay, market price to book value ratio. There you go. Almost 5. And what does that mean? I told you if this ratio is greater than 1, stock is overvalued, right? But it also means there is a lot of positive expectation, right? A lot of positive expectation built into this market price of this stock, right? And overvalued means, in this case, in this context, is simply it simply means it's greater than the book value, right? Those positive expectations may be sufficiently substantiated or corroborated by the actual earnings growth, right? If the earnings growth is good enough to support this price earnings overvalued price market price to book value ratio, then it's not a fluff. You understand? It's not just a fluff. I mean, sometimes the overvaluation is purely a result of speculation, right? But sometimes it is not. It can be. It is supported and corroborated by the actual good growth rate in earnings. Okay, so that completes, right? That completes the our exercise of the ratio analysis. So this was rather a brief segment, because actually it would have been this should have been incorporated to the previous segment, but then the previous segment ran more than an hour, so this had to be split up into a separate, its own separate segment. So it's rather a brief one, but all the more reason I want you to study this segment, view this video, watch this video together with the other videos of ratio analysis. Okay, all right. Thanks for joining the session. Thanks for watching, and this is the end of the video. I'll see you in the next class.